Trade smarter. Welcome back. I'm Finn, and this is Elo. Today, we'll guide you through one of the most important tools in a trader's arsenal, indicators. In this lesson, you'll learn what indicators are, how to use them, and which types are best for spotting momentum. You've likely heard of indicators. Let's break them down. They're math-based tools that analyze price or volume to help you spot trends, momentum shifts, and key market signals. Indicators are designed to help traders understand what the market is doing right now, and what it might do next. They are not direct buy or sell signals, but tools to guide decisions by highlighting patterns and market behavior. Every strategy needs the right tools. Trend indicators like moving averages show direction, while momentum tools like RSI or MACD spot shifts or reversals. This may sound complicated, but do not worry, we will guide you through every indicator in the upcoming lessons. So the thing is, price charts show market movement, but not always the meaning. Indicators add context, confirming trends or questioning momentum, to reduce guesswork and improve your decisions. Have you ever second-guessed a trade or acted on impulse? In volatile markets, emotions can quickly override logic. Technical indicators help remove that uncertainty by offering consistent, data-based signals. By relying on objective tools rather than gut feelings, you're more likely to follow your plan and make disciplined, well-timed decisions. Consistency is another key to developing a sustainable trading approach. Indicators allow traders to apply the same logic across different trades, reducing variation in how decisions are made. With clear signals and repeatable rules, you can measure their performance more effectively, refine your strategies, and improve over time. Lastly, the market is full of information, and not all of it is useful. Indicators act as filters, helping you focus on what matters most. They take the complexity of price movements and present it in a way that's easier to interpret and act on. That said, using too many indicators can be counterproductive. The goal is to find a small set of tools that support your strategy, tools that help clarify the market, not complicate it. Pick the right. Why should you use indicators? Let's put your knowledge to the test. Select the 3 main reasons traders use indicators. Predict exact timing. Replace trading strategy. Spot entries and exits. Reduce emotional decisions. Guarantee profits. Confirm market moves. Stock? Excellent. Now that you understand why indicators are essential, it's time to look deeper. Not all technical indicators serve the same function. Most fall into one of 2 main categories, leading and lagging. Let's take a closer look at each category. Leading indicators are designed to anticipate future price movements. They analyze current market conditions to suggest where the price might go next. Traders often use them to identify early signs of reversals or shifts in momentum before the actual price move occurs. While leading indicators can offer earlier entry opportunities, they also carry a higher risk of false signals. They are most effective when used in combination with other forms of confirmation. Lagging indicators are used to confirm what the market is already doing. Instead of predicting future movements, they validate trends that are currently in progress. These tools are often based on historical data and smooth out price action to reduce noise. Because they react after a move has begun, lagging indicators can help traders avoid premature entries and stay aligned with broader market trends. They are especially useful in trend-following strategies where confirmation is more important than early entry. Select the match, leading versus lagging. What's the difference? Can you tell which indicators act first and which follow? Drag and match each type of indicator to its correct description. Acts before price moves. Leading indicator. Confirms existing trends. Lagging indicator. Stock. Well done. You now know what technical indicators are, why traders use them, and the key difference between leading and lagging types. In the next lesson, we'll dive deeper into leading indicators. You'll learn how specific leading indicators work, what they reveal, and how to use them to identify potential market moves before they happen. How to spot a trend before it happens. Today, we'll break down two types of indicators, leading and lagging, and show you how traders use them to anticipate or confirm market moves. You'll learn how tools like RSI and moving averages help sharpen your entries, exits, and confidence. Leading indicators are used to predict future price movements before a trend starts. They are meant to help traders anticipate what might happen next, not confirm what already occurred. But leading indicators aren't crystal balls. They highlight potential shifts in market pressure or momentum, early warnings, not guarantees. To help you use them well, we talk more about market pressure and momentum in upcoming lessons. Now let's explore one of the most common leading indicators, the Relative Strength Index, RSI. It measures how strong recent price movements are and shows whether something might be overbought, too high, or oversold, too low. The RSI gives you a number between 0 and 100, and that number can help you decide when to enter or exit a trade. In other words, RSI can help you catch potential reversals, times when the market might change direction. Here's the simplest way to use it. RSI below 30, market may be oversold. Potential buy signal RSI around 50, neutral zone. No strong signal RSI above 70, market may be overbought. Potential sell or take profit signal. An RSI of 72 means the market may be overbought. That's often a sign the price could pull back soon. Instead of buying, traders usually wait, or look to sell when RSI is above 70. Now, let's move on to lagging indicators. They help traders confirm trend direction, filter out short-term price noise, and avoid acting on false signals. They're especially useful in trending markets, where the goal is to stay in the move as long as it lasts. Instead of reacting to each new price movement instantly, lagging indicators look at patterns in past price data over a set number of periods. They calculate averages, trends, or changes based on that data to reveal what direction the market is moving in overall. Because they wait for confirmation, lagging indicators are often slower to respond than leading indicators. They don't try to catch the start of a move, they wait until the move is real. The delay makes lagging indicators more reliable in spotting true trends, and in filtering out fake moves. Now that you know how lagging indicators work, let's see how they help traders confirm that a trend is real. Each one uses price data a little differently, but they all aim to filter out the noise and show you whether the market is truly trending or just bouncing around. One of the most popular lagging indicators is the moving average, MA. It calculates the average of past prices over a set period to create a smooth line on your chart. This line filters out daily fluctuations and shows the general market direction, making it easier to stay focused on the trend. If the price consistently stays above the MA, it's a sign of an uptrend. If it remains below, it often confirms a downtrend. MAs don't predict what's coming next, but they give traders confidence that the trend they're seeing is real and worth following. Use the indicator to make a decision. The price has just broken above the moving average and stayed there for the last few candles. The moving average is starting to slope upward. Quiz: what does this most likely indicate? Explanation: exactly. A break and hold above a rising moving average is a strong sign of a developing uptrend. Many traders see this as confirmation to enter long. Great work. Now you know the difference between leading and lagging indicators, and how they help you anticipate or confirm market moves. But indicators alone aren't enough. In the next lesson, we'll explore how indicators and price action work together, and why smart traders let indicators confirm the story, not replace it.